Good morning, everyone. This is Stuart. We hope you had an enjoyable weekend. On this week's market update, we're going to talk all about Alphabet. Over the last few years, Alphabet's stock performance has materially lagged that of its large cap tech peers over concerns about the outlook for its search business in the face of potentially new competition in the age of artificial intelligence, and due to increased antitrust scrutiny from US and European regulators. While we understand these concerns, we think they are largely overblown and that the stock's underperformance is unwarranted. Despite continuing to put up impressive revenue and earnings growth, Alphabet stock now trades at a 6-turn price-to-earnings ratio discount to the S&P 500, with the forward PE for Alphabet at 18 times earnings versus 24 times earnings for the broader market. This is the largest discount to the market multiple in Alphabet's entire trading history, now spanning nearly 20 years. The market is pricing Alphabet as if it's about to enter terminal decline rather than operating solidly across its multiple business lines. Again, there are legitimate concerns about business competition, but given the discounted valuation, the bar for Alphabet performing well from here is far lower than when the company commanded a premium multiple. As we can see from Alphabet's financial summary, the company's revenue and earnings are still growing at robust double-digit rates, 13% and 20% respectively over the last year. This compares to 6% sales growth and only 12% earnings growth for the S&P 500. Fundamental challenges have yet to hit the company's top and bottom lines, and we think that will remain the case going forward. Let's go over why. The much maligned search business, which many fear will be structurally pressured in the age of AI, actually reaccelerated last quarter with 12% year-over-year growth as both the key cost per click and paid click metrics have inflected upwards. To put it simply, the idea that ChatGPT and other AI models will make Google a relic is not proving out. In fact, the opposite seems to be the case, as Google has elegantly incorporated AI overviews into its search function and continues to prove commercially valuable to advertisers as a discovery and customer acquisition tool. In a world of vastly more content and more slop content generated by AI, we think the ability to parse through information to determine what matters and then sell relevant ads against those results will be even more valuable. The Google Cloud business and YouTube are also hitting on all strides, with annual revenue run rates from those businesses alone now at $116 billion. On the cloud front, Google has inherent advantages given their industry-leading architecture and customized TPU chips developed internally. Google notably is the only big tech firm not reliant on NVIDIA for its compute. And let's not forget the accelerating rollout of Waymo's driverless rideshare business or commercial opportunities driven by Google DeepMind's industry-leading AI models in fields like manufacturing, chemical engineering, and protein folding for biotech. Finally, on the AI front, Gemini is proving its might. Monthly active users have now reached 450 million. On many metrics such as speed, cost, and context window size, Gemini exceeds that of competitors like ChatGPT and Anthropic's Claude. Gemini is now processing nearly 1 quadrillion tokens per month, double the number from just this spring, as use of its model becomes more widespread. And, in a bullish sign, the company continues to increase its capital expenditure guidance, raising the yearly outlook by another $10 billion last week to $85 billion for the year, as demand for Alphabet's cloud and AI businesses exceed the firm's ability to supply computing power. In short, Alphabet, which was admittedly slow out of the gate with AI, is now a business firing on all cylinders and proving out its advantages in scale, engineering, data science, and talent. We think the valuation discount to other large cap tech firms and the market generally is unjustified and expect the company to benefit from both continued earnings growth and an expanding earnings multiple. While the competition has heated up, Alphabet is in prime position to not only defend its core businesses, but grow them. Please let us know if you'd like to discuss the merits and risks of investing in Alphabet for your portfolio. Thank you and have a great week.